The streets of Pakistan's largest city are bustling with activity, but traders at the stock exchange in Karachi have little to do as they watch equity prices collapse. Investors in most countries are feeling similar despair as shares have tumbled all week. Yet economies around the world are performing better than they have in many years.
Fundamentally, the economy is still really strong. We're seeing GDP improve quarter over quarter, not quite as fast as we wanted to, although the IMF just came out with predictions that we can expect an improvement up to 3.9%. So definitely an optimistic sign. If you look at this earnings season, about 80% of companies that are reporting are surprising to the upside, and the earnings growth has been over 14%. So fundamentally, I really think that there's some strong signs behind the market still.
Ironically, this pickup in economic activity is what's driving investors' fears. That's because it makes central banks more likely to hike interest rates, which is making stocks less attractive.
The committee judges that, were the economy to evolve broadly in line with its February inflation report projections, monetary policy would need to be tightened somewhat earlier and by a somewhat greater extent over the forecast period than it had anticipated at the time of the November report.
Share prices in Asia are now at their lowest level in 2 months. US markets have dropped into a correction which analysts say could drag prices even lower. That's bad news considering the week-long rout has already wiped out more than $4 trillion from global markets. The gloom isn't limited to stocks. Analysts expect oil prices to fall below $60 per barrel, and that could mean more pain for investors everywhere. Mobin Nasir, TRT World.
Now, for more on this, our editor-at-large, Craig Copetas, joins us from Paris. But first, let's speak to David Madden, who is a market analyst at CMC Markets. Thanks so much for joining us, David. Now, explain this to me. Aren't stock markets supposed to reflect the real economy? So why are they moving in opposite directions?
Well, traditionally, the stock market represents what the economy is going to be like down the line, say 3 or 6 or 9 months down the line. But the reason why we're seeing a divergence between a very strong economic fundamental for the global economy and a sell-off in global stock markets is because essentially stocks were overvalued to begin with a few weeks ago. And now that it appears we're going to have tighter monetary policy around the world in the form of higher interest rates from the Federal Reserve in the United States, and possibly a trimming of the stimulus package in the Eurozone, and also is a further trimming of the stimulus package in Japan. So essentially, in January of this year, stock markets were looking quite lofty, and then when economic data came out in recent weeks to show the global economy is performing better than initially anticipated, traders are now getting worried that the monetary policy is going to tighten quicker than they anticipated, so all of a sudden they are flying out of equities and into safe haven assets such as bonds and cash.
OK, and Craig, I want to ask you, the US government recently introduced tax breaks. Shouldn't this be reflecting positively on the markets? What are you hearing?
Well, yeah, it's going to reflect positively on the markets, but remember, the markets are not the economy. And it really troubles me to keep hearing the pundit say episodic volatility. Stock markets have been volatile since the invention of equities back in the Renaissance. You have optimistic volatility, which we have seen for the past few years, and now we're experiencing pessimistic volatility. Stock markets are volatile by definition, by nature. It's built into their DNA. But the psychology of the market is people freak out, and they freak out. How they freak out is based what they bought into the equity at. If you bought into Apple, say 20 years ago, you're still doing fine.
OK, I want to talk to David about freaking out, because there was a lot of fear earlier in the week about rising interest rates. And now these fears have been confirmed. Do you expect then the market rout to deepen?
I think for the time being, there are no signs from a charting point of view that the market rout is coming to an end. In my view, this rout won't last particularly long because the fundamentals of the global economy are still quite strong. I would deem this a good stock market sell-off in that stock markets were overvalued in the first place. The global economy is growing at a faster pace than originally anticipated, so now traders are cashing in those overvalued stocks. Granted, there has been a spike in volatility, as Craig would say, negative volatility, but this happens from time to time. At the start of this year, traders were sleepwalking into the bull market that we were in, and some investors forgot that stocks can fall as well as rise. OK.
Craig, I see you nodding there. What would you like to say on this?
Well, David's, absolutely correct. I think you have to give this some size and scope to really understand it. This is a correction. Now, on Apple on Thursday, for instance, lost 2.75% of its value. It now has it lost $22 million in market value. Now, that seems like an awful lot of money, and it is, but that's correction money. Now, put that against the amount of money that Apple has overseas that they're going to be bringing back to the United States. That's $252 billion. And that gives you a rough, a rough estimate of how the scales are balanced, at least with the cash flow. Market ups and downs are routine. And what you're seeing now, the freakouts are completely psychological. Okay. What's happening is not carnage, it's correction. If they go to a bear market, if it drops more than 20%, then we might be looking at carnage. And I'd like to see if David agrees with that.
David, do you agree? It's not carnage, it's correction.
I'm definitely in favour with what Craig has to say. This is correction territory we're in. As Craig pointed out, if the stock markets drop below 20% from the all-time highs which were created recently, then we could be looking at carnage, and that's when we could look to see at a faster rate of traders exiting the market. But in the last 9 months, we have seen some pretty deep sell-offs. But by and large, because the underlying economic indicators are positive, we have resumed normal territory back to business and go on to push on to higher highs. Okay. So in summation, in my view, this is a correction, not a carried sell-off.
OK. David, I want to ask you about oil, because prices there are also falling. Is this just OPEC versing new emerging players such as the US, or is there something else behind this that we don't know about?
I think this is largely driven by the fact that OPEC started off by bringing in a coordinated production freeze, which is going to last until the end of 2018 to ramp up the price of oil. The reaction to that was increased shale production in the United States. Okay. As of this week, oil production in the United States has exceeded 10 million barrels per day. That's a record high for the United States. Now we've seen countries such as Iran want to look up to expand their oil production by up to 700,000 barrels per day in the next few years. So okay. I think this is one of those cases of higher oil prices attract higher production. Okay. And in turn, we will get the ebb and flow, and traders will take profits on high energy prices. All right, gentlemen, we'll have to leave it there. Thank you very much to both of you. That was Craig Copetas in Paris and Dave Madden in London.